All right, let's talk some tech. Let's get ready for earnings, and let's look at Apple some more. Day two here, and shares are doing a lot better. We got Tom White in the studio looking at the options market reaction, and Oracle ahead of earnings. We got Robert Cantwell joining us from Up Holdings Investment Management, taking a look at the stories here, founder and portfolio managers. So, Robert, what'd you make of Apple's conference yesterday, and how should we interpret a sell-off in the shares yesterday versus a rally this morning?
Yeah, look at 2% down yesterday, back up 2 today. This has kind of become the story for Apple. They do a release of products and services. They disappoint everybody a little bit. And then the next morning, everybody wakes up and remembers how dominant Apple's position is. And you had Elon crying all night that maybe Apple might have been the winner and said, uh-oh, they're making ChatGPT the default. That's going to make it real hard for me to get my new AI service on Apple devices. So I think that's a little bit of some of the market reaction you're seeing today. But like this AI thing as a whole, we're this is a very important year. ChatGPT came out 18 months ago. This is the biggest spend year. We count about $70 billion of fresh cash from bigger CapEx budgets, from venture capital deployments. They're going to go into building AI stuff this year. And what Apple released yesterday, people didn't see anything that Apple was going to be able to make more revenue on. And I think that's part of what a little bit of the disappointment was yesterday. But that's been the story with AI so far. I think it's going to continue to disappoint investors in the short run on revenue, but its impact long-term on what it can do on the cost savings and the productivity side, I think that's where we're really going to see the impact of how this technology plays out.
Tell me where, when you talk about that impact from Apple for a financial standpoint, as an investment, or for us as consumers, both, I guess?
Well, in Apple's case, we have to remember that they give the software away for free, and they charge us for the hardware, and that's what makes it really challenging to compete against Apple's services, because they're not. How are other companies going to be able to charge for on-edge AI services? This integration that they're offering with ChatGPT here, this is one of the tightest integrations that we've seen Apple offer with any company not named Google. So this is not something that's in consumers' hands yet. It is not backwards compatible into previous versions of the iPhone before the 15. So we're a very long way of seeing how this plays out in practice. But this technology of what ChatGPT represents, some will discard it as, oh gosh, we had the calculator. But the calculator was the embodiment of computational mathematics. And ChatGPT is the embodiment of computational language. So for all the writers and creators that have had to write novels and develop ads and build all this content without actually having their version of a calculator, that's really what we see this commercializing itself in a way where there's going to be really cool tools on the computational language side that's just going to enable so much more production out of people. And Apple, as one of the key enablers of creative and production services, it's a very natural area for them to be offering what they're doing here.
Okay, well argued. I like the idea of creative calculator. So the investment thesis around it, is it clear what that timeline is? Is it just, look, Apple is Apple, buy it, hold it, keep it in the portfolio, or is it try to time when this is going to actually come out and when it's going to drive an upgrade cycle?
So Apple's had a funny start to the year. They had the weak China in the first quarter, then they had the China bounce back in the second quarter. What's happening at a real macro level for Apple right now is, in this higher interest rate environment, is you've been seeing the replacement cycle for iPhones slow down a little bit. And that's the biggest overhang to Apple performance here over the course of the rest of this year. So we're not expecting big things from the 16 coming out. We're not expecting a ton of revenue surprises from AI and Apple this year. So I think, for the most part, this is going to be a steady as it goes year with Apple maintaining its dominant position. And where we're spending most of our time now is on the places outside of AI, where there's a little bit less attention, because AI is going to continue to grow the web here with all this incremental spend we're talking about. So companies like Adyen, VeriSign, Google, that are these monopoly toll takers in other parts of the internet, that's where we've been kind of seeing the most opportunities lately.
All right. Hang with us, because I do want to talk some Oracle here ahead of earnings. Tom, looking at the Apple options, though, today, has anything changed in kind of the market structure around what people are trading?
Yeah, it's more bullish, that's for sure. Implied volatility levels have been cratering since that event risk came out during their announcement. So that provides some opportunities. Stock's bouncing back. So typically, when they get to the Worldwide Developers Conference, stock rallies into it, sells off for a few days, maybe a week or two, and then starts to rally over the next month to 3 months. We're seeing it in one day today, so how do you take advantage of that?
The market down, though, I feel like helps, too, because Apple literally trades like a bond these days.
It does, yeah,
So
all the cash on the balance sheet.
I would offer there, too, though.
Yep. So I looked at a strategy that gives me that duration, where if you think it's going to continue to rebound, maybe they do have that super cycle that starts, because only the Apple iPhone 15 and Pro and the Pro Max are going to have these capabilities that are coming down the pipeline as far as AI goes. Maybe that super cycle happens. Going out to the August monthly cycle, so 66 days till expiration on this position. And this example trade takes advantage of some upside, but hey, you only need it to go to maybe 210 is where you want it to go, but anything above the break even is going to be profitability. Buy one of the 195 strike calls, currently slightly in the money by a couple bucks. Sell two of the 210 strike calls, and then buy one of the 215 strike calls, paying roughly a $5 debit for this unbalanced or broken wing butterfly here. That break even of $200 over the next 66 days. It's only about 1.5% above the current share price in there. So you don't need a monster move to the upside, and you're being more conservative with your outlook. Yeah, you want it to go to at or near 210. But anything even above 215 is going to be more than a double on this type of trade. So, yeah, you're taking advantage of duration and the fact that you're going to get another earnings event in there also.
True. All right, so a 2-month trade with a pretty good range that you can benefit from to the upside.
Yep.
Okay, but risk defined as well, so you get capped out on the upside too. All right, let's talk some Oracle. As we look at, a pretty big report after last time. Robert, thinking about how the bar has shifted here when we got that gap up all-time high on the last earnings for Oracle. What does that kind of put on the agenda here this afternoon? How do they keep that energy going?
So Oracle of the big four hyperscalers is the most interesting in some ways, because this was originally their market. They just happened to build it on premise, and they've been working to convert it off premise. So they're the legacy provider that's been competing against the cloud native hyperscalers, and they've been doing a decent job, but they're still trailing. They're losing share. In general, folks want to own AWS, Google Cloud, and Azure. Honestly, what's more interesting about where in Oracle, and when they're reporting later today, is getting back to the AI stuff we were talking about before. These hyperscalers are generally regarded as the four picks and axe, providers to the AI universe. And they have seen their revenue reaccelerate these last couple quarters, and Oracle has been a part of that. And that's surprised folks a little bit to see an older legacy mainframe on-premise hyperscaler be able to make this cloud transition, be able to participate in this revenue reacceleration. And we haven't seen this AI spending slow down yet. And so that's likely to be continuing to buoy Oracle's results here in the short term. But what we really care about is how they're talking about capital investment into their own business here in these next couple quarters, because the NVIDIAs and the other semiconductors that have been so volatile, they're likely to trade more. I expect a bigger move in NVIDIA after hours than I do in Oracle's own results based on what they tell us.
Interesting. So you're looking at it for insight on NVIDIA and the chips too. If Oracle spends on that, will the market be okay with it because it's growth-oriented spending, or is too much CapEx going to limit where the stock can rally?
Interestingly, the market right now has been rewarding incremental CapEx. Microsoft is doubling from $25 to $50 billion. You've seen their free cash flow multiple as high as 50 times now. So the market is being willing to look through this capital investment cycle. And like Amazon a couple of years ago, they're sort of assuming that CapEx is going to moderate in the years ahead. So honestly, if Oracle comes out with a revenue beat and a higher capital intensity forecast, I don't think that's something the market's going to be upset about.
All right, great stuff. Fantastic analysis. Really good angles on that. Appreciate it, Robert Cantwell, Upholdings Investment Management. All right, Tom, let's trade Oracle. What do you think? How's the options market looking?
Plus or minus about 7% move in the shares. Either way, about $9. And you mentioned the rally to all-time highs post earnings last quarter. So you have that. Look at the RPO on this one, remaining performance obligation on it. I think that's going to be key. We've got a strategy here that takes advantage of implied volatility dispersion here. So we looked at a call diagonal. And I went out to the July monthly cycle, so just over a month until expiration, about 38 days, where I'm going to buy something slightly in the money, the 120 strike call, and then I'm going to sell something in the near term, June 14th, weekly options that expire in just 3 days. I'm going to sell the 130 strike call, so a bullish $10 wide call diagonal to the upside on this one. I'm going to pay roughly about a $5.20 debit for this, so almost about half of the width of the call diagonal. That's good, the good part of it. And it's lower price because you're basically buying a 38% IV or implied volatility percentile in the July option, selling about 102% in the near-term June option. So that contracts the price and the risk on this trade.
I like that.
Your break even about 123 on this one. So you're taking advantage of upside, but you're taking advantage of the lower cost on the call diagonal. And then as you get closer to expiration over the next 3 days, earnings will be out, vol will collapse in those short options that you sold. And then you have that ability to roll or adjust it. But it's definitely a bullish trade. You want it to go up that one standard deviation, which is at or near that 130 strike, but anything above the break-even's profitability.
I like it because you're betting that kind of it got that major ramp out of its system on the last earnings, that it won't be able to replicate that again. But it still is betting on Oracle over the longer term. It's just betting that the move is going to be a little bit more measured and a little bit more paced. But it's also a fun trade. We've got the different expiries too, because you can manage the trade depending on
based on your assumption on where you think the stock's going to go, and then you start looking at durations, and then you start looking at the price of these type of trades. So you can go out to August, you can go out to September to buy that option, just depending on your duration, where you think it's going to be over a specific amount of time.
And there's enough bullishness to drive up the premium in the ones expiring this week, right?
Yep.
Is the one right?
And that's why
for Friday.
Yeah, that's why the $10 width of the call diagonal, you're paying about half of the width. So that right there lends support to that dispersion between implied volatilities, which lowers your risk on this trade.
Got it. Okay. All right. Oracle down 1% ahead of the earnings. Thanks for the trades, Tom.